Okay, so the first thing you need to know is going to be the kill zone times or the kill zone um, like areas. Now, as a prerequisite to this, if you have not already seen ICT's Silver Bullet Strategy video, this won't make as much sense. So after this video, like I said, I am recording it. You can go back and watch that. So there's going to be two prerequisites. And for you guys, I'm obviously going to explain it, but if you go to the actual videos themselves, you'll be able to make a little more sense of it. So the first one is going to be obviously the ICT Silver Bullet. That's going to give you the times, and I'll give you the times here too in just a sec. This is the first prerequisite because it teaches not only the times but the strategy that we're looking for. Now the second one, besides just looking for silver bullet, the second one, if you just type in dr/IDR, and that is taught by I think it's the master, but MAS7ER. He teaches the DR and IDR concepts, and we're just going to be talking about a similar way of viewing the market. And I'm not going to go through all of that, but if you watch these two videos and then watch this one, or if you watch this one and watch these two videos, either way, it'll make a lot of sense. It doesn't really have to watch them in order, but if you watch those, you'll understand what I'm talking about, especially after watching this video. So first thing we need to do is we need to throw, and the times are in that video right here. These are our silver bullet sessions. So the way that our silver bullet session works is, let me draw real quick. For example, this right here is 10 o'clock a.m. and that's Central Time. So what we do is 10 minutes before that range. So 9:50 to 9:59 is what we're highlighting with this blue box. So it's only a 10-minute range. So like basically 2 5-minute candles. Now we have our range. Now right here you can see at 10 o'clock that candle opens, that 10 o'clock candle. And it immediately trades down, and you see right there how it closes below the range. So there is, and this is during London, about a 78-79% chance, and it's about a 60% chance during New York and about a 55% chance during Asia. But we'll talk about this as far as if it closes below this range. Right there you can see it closes below and then closes below, closes below. If it closes below the range, there's about a 70 to 80% chance that it ends up closing lower than this open. Right? So right here, we'd see the short. And you can either enter short here with your stop above here, or what I recommend is entering short at 50%. You don't have to just use it blindly like that. You can use the PD arrays, meaning you can look for your order blocks, your fair value gaps, reasons to enter, but that is how I view it. If it closes below, I'm not just going to enter blindly right here at the low. What I'm going to do is I'm going to wait for some kind of pullback to enter. But as far as the method is concerned, it closed below, and then at the end of this hour, let me get the exact candle, right here at 1800, which is now 11 o'clock, that closes below the open. So this scenario would be considered a win. Whether we captured 52 pips, 36, or if we entered at the middle and caught about 67 is irrelevant. right? It's all going to be still us trading. But one word to the wise or tip that I could give you is if you measure this range, your target should always be at least one standard deviation of the range. So if you got short right here on that close, say you went short with your stop above the range, your first target, or you really with these, it's just a scalp. So really it's your only target. Now, if they keep running or if you get something extra, great. But generally that's all we're looking for. You can see this one, it went 2 deviations. So let's go through a couple of them. So right here's another one. You can see this one is during Asia. We get that 10-minute range and then it opens. Look what happens. Closes below that range, pulls back up into it, and it goes short. Remember, we can measure this range and our target is that 1 standard deviation. You can see this one goes for 10 standard deviations, maybe more, but you can see it closed below. So that's where we want to start looking to go short. Let's look at a couple more. So there's 3. Again, remember, there's Asia, and then there's New York, and then there's post New York. So those are the three main kill zones for the silver bullet. So let's look at this one again. So because it starts to get a little tricky sometimes. So for example, we get this 10-minute range during Asia. Look what happens. It closes above. So are we bullish or bearish? We're bullish. Now, if we just bought right there, what would happen? We'd get stopped out. If we bought at the 50%, what's likely to happen? We got stopped out. So there will be some scenarios where it's either wrong or there's a stop out. Now, let me kind of, in the DR world, this is what they call a retirement setup. So, for example, I think of it like a slingshot. That's what I would call it, is more like a slingshot. Where did I tell you the general area was for taking profit? 1 standard deviation. So if we get confirmation, like right here, we get a close above the range. That's telling us what? That it's more likely to close above this level at the end of the hour. So you can see the hour goes from here to here. Now, when it closes above and it trades down 1 standard deviation, remember, we've already been given the buy signal first. So we can actually look to buy down here. And now our take profit, right? We just flip the standard deviation to the upside because that's still our target. And our profit target, our first one, is right there. So that's our target. Say that we end up getting long right here after the open. Say it trades down, we see that, then it trades up here, we see that double top, and we just try to get in somewhere at this gap. Say we put our stop below that order block and we enter as it pulls back into the open. Right there, there's your 1-to-1, there's your 2-to-1. It ends up going for 5-to-1. But you could have got really 3-to-1 pretty fast without any trouble. Does anyone have any questions so far? It's more of a complex method, but once you know the rules, it starts to get a lot easier. Here's another one. I want to show you guys some that fail too. But right here, you can see it opens, closes above the range. So that means we're bullish. Trades back into the open right there and trades around and then really takes off. Yeah, at least 10-to-1 on the standard deviations there. Okay, cool. So here's one that fails. So we create the range, we open right here at 10 o'clock, and we trade below the range. And then it turns around and heads up for the high. We don't really get a standard deviation on either side. So some situations like this are just going to happen. Now, there are still ways to be profitable with these setups. So like, for example, we got a bearish close below this range. So where are we looking to go short? Well, we're looking for a setup either around the open at the 50%, or like I said, that retirement setup. So we have the one standard deviation that it obviously doesn't reach within that hour. But when we clear that high, we can actually look to sell that high if we start having a setup there and if context is there. So like you can see, bond open was right here and it was extremely bullish. And so this context right here is just part of a pullback. So even, you know, with context, it does matter, but you don't always have to apply that. So like I was saying, you could either capture this short or you just end up being wrong, maybe taking a loss on that. Right here, we get a good example. Right there, it closes below. So now we have that close below, trades back up. Same as the last setup we just saw. We got that original confirmation, and then it trades above the range. We can sell into that because of the confirmation here, and we would target that one standard deviation. And you can see this one goes for 3. Here's one. It's a little tricky because the only close below the range is just this one small candle here, but that would still count. You might get caught up in a short trade, and then this one would have been a loser. This one as well, traded below, ended up failing and then consolidating. Here's a pretty good one. So this is that 10 o'clock candle. It opens. And so the range is a little messed up, but you can see this candle here is still 959. So the box just didn't get the high of that last candle. But you can see right here, this red candle is the 10 o'clock open, and it immediately closes below. So you're already below that range, pulls back up, could sell into that order block and 50% of the range, and that would have given you a really big trade. Here's one where it closes above, pulls back into it. You might have got a small scalp, but would have ended up failing. Right here, here's one that traded above it, just pulled right back into the open, traded away. And so one thing that I would challenge you, same thing, trades above it, closes above, trades away. One thing I would challenge you to do is when you use these, make sure that you're using context. Like for example, let's just look at this fair value gap today. So obviously it formed here, and then we filled it here. So let's just look at that throughout the week and see what levels were around that. So the fair value gap forms here. Remember, this is a 4-hour fair value gap. It forms during the price action right here, the silver bullet. Look at that. So why is this likely to be a good trade and pan out? Well, because they just formed a 4-hour fair value gap here. So now they're likely to trade away from it because they just formed it. Now, this one, if it closed below it, I wouldn't blame you if you went short, right? This is on the 25th. The second one on the 25th. There's the first one. Here's the second one. So if you went short on this one, I really wouldn't blame you. Even if you took a retirement setup, say you went short at 1-to-1 and you started looking to go short up here, I wouldn't blame you because you're going short toward this 4-hour fair value gap. Now, granted, I don't know what was above that, but just to give some context. Now, for this one here, I would say it would be silly. Why would this one be silly to take a short? Right now, I wouldn't have been mad at you if you took a short on this one. Why? Because it's trading toward a 4-hour fair value gap. Now look what happens. We fill that 4-hour fair value gap, and what happens? Massive rejection. Then right here, after we fill that gap on the 26th, look at this. It closes below it. Are you going to sell that and trade it toward a 4-hour fair value gap that has already failed? Most likely not. So that's what I'm saying. Even if it closes below it, if you use context, it makes it that much better. So in this scenario, you can go, well, I don't think it's going to trade down to this fair value gap. So in the event that I'm wrong, right, that this setup is wrong, it closed below, do I really think that it could go lower? If yes, you could sell up here. If no, then you can start buying these setups when they dip down, right? So when it dips down into this fair value gap, you know it's at least an okay shot if you take a long, because that 4-hour fair value gap's already been filled. Same thing here, that 4-hour fair value gap already got attacked, and then boom, they run up, take more liquidity. They spend better use of their time. Now let's look at another one. So this was the high of the week. $530.14. Okay, we're all on it. So this was the high of the week until what? Until this took it out. Now they traded up. Look at that level. Is that order block random? No, that's the open on that candle. So you can see they trade up into the order block. They pull back. It ends up rejecting, and then they go out and they take out that high of the week. So if you were bearish here on this one, that's okay, but it would be easy for you to want to flip to bullish if the high of the week is right there, and if you knew it was right there. So right here, you see your silver bullet, you see it close above the range. You can just place a limit and start looking for this area. That becomes your target, is that weekly high. Then it runs that weekly high, comes right back down, runs all these lows. And so the same thing can be said for the next day, right? Then we have this daily high that was formed. So today, when we're looking at our silver bullet sessions, maybe this one could have gone either way, but you see this silver bullet session here? We've already been above the high of the day. So why would we try to reach above that high of the day again? We probably won't. And if we do, then we'll probably keep going higher, and then our next silver bullet will give us a setup. But we've already rated that high of the day. So when the silver bullet hits right here, you can feel comfortable looking for a short. Now, if you just caught it within this hour, there's your fib. Remember that 50% is sensitive a lot of the time. See that? And then it sells off. Now, this is what I want you to pay attention to. They do reach back above that previous day. Where are most people going to take profit? Well, we're looking at that area, 1 standard deviation. Runs to it, stops it out, runs right above that daily high one last time, and then dumps. So now after you've seen this high, you figured this one was probably bearish. You've seen the high get run again, and then it starts dumping, and then you get your silver bullet pattern. It closes below, quick retest, and then sells off toward a 4-hour fair value gap. And keeps going. Cool. Does anyone have any questions on any of this? You can go ahead and ask them out loud. It'll be easier. So there's three. There's Asia, London, and New York. Or really, it's excuse me, it's London. Those are the only ones I use. Are London, New York, and post New York. What's the time for London? So if you go to the ICT Silver Bullet video, it'll give you all the exact times. I don't want to give you the wrong times or anything like that. And then, work with this for a minute and kind of look at it on TradingView. And if you're interested in trading this strategy, just let me know and we can set up a meeting and talk about it and get you everything you need to trade it. But it's a cool strategy, but you still have to pair it with context. You really don't want to try to just follow it blind. And it will really help you get in some good trades, not just scalps, but good trades as well. And so far, no one really asked this, but so far I've only really worked with it on US 30. So I know it works with EU and GU as well. When I tested it, it did not work as well, but it still worked. So let's look at that weekly high. That was sweet. We just ran that weekly high and turned. So I want to see what that looks like. And then I want to see what it looked like trying to get to this fair value gap. And then I want to see what it looked like trying to fill this fair value gap. So no one has any questions? Do you guys like this strategy? Let me know. Just comment real quick. Do you feel like you understand the strategy? Like 1 to 10, how well? Because I know we just started going through it. So 1 to 10, how good do you feel about the strategy?
It's just a like repetition of watching it over and over again and plotting it out. So I'm like about a 7 with it.
Okay, cool. So let's look at this. So this was high of the week. I'll just go ahead and detail them as well. This one is the 4-hour fair value gap. And then this here is also a 4-hour fair value gap. So let's go. So this 4-hour fair value gap is formed right here, and this is Monday. Again, we trade up, form the high of the week, we trade down. This, if we're just talking about silver bullet, would have been a losing pattern. Now, this one here, I would not blame you if you tried to go long on it. Why? Because there's a 4-hour fair value gap here. But it ended up closing lower, so we would short that one. You see it went short off the open. And then this one too. So now we have a 4-hour fair value gap there. So anytime we close above one of our silver bullet sessions now, it's going to be a little more sensitive looking for that area. So right here, we ended up closing below again. So we're short. It ends up working. Gets you in like a really good trade there. Now, right here, we close bearish. So it's short. It ends up giving a short and it wins. Why? Because it goes one standard deviation at least. But then it turns around. So that's worth noting, right? After an hour, we only look within that hour. It turned around. So that is a shift. Remember that 4-hour gap is still there. Now right here, we trade and then we immediately close above. We'd have to go down. It's on the 25th. Oh, we closed down first. So this one, you'd end up probably going bearish up here and it would go one standard deviation. This one would be a really tough one to use because the range is so small. You know, you're only using 10 minutes and you do want that range to be at least a little sizable. I would say at least, you know, if you're on Euro, I would say at least 5 pips. But nonetheless, it goes off the open and it starts trading higher. We know that there is that fair value gap up there. So right here, it starts trading higher. Now, right here, we form a new fair value gap on the 4-hour. So if you went short here, I wouldn't blame you. So it trades into it just a little bit, comes back again. Now right here, this one might be a little tricky, but you have to remember this 4-hour fair value gap here. So ends up trading. Looks like it closes above and then ends up going long. Comes back around the hour. Now look at this New York one, or post New York. It tries to get that 4-hour fair value gap, but I want you to see how it's reaching for it. The market does not want this 4-hour fair value gap. It made it here. It created it. That's it, where it happened. Now, they come back right here. Can't do it. Come back right here. They close bullish, reach back as far as they can. That's a retirement setup, and then pull back. And then look what happens there. Huge, huge move. And then another one. Remember, this one actually did close above the range. Comes all the way back to 50% of that range. Trades all the way up again. Then comes all the way back down to the open. Taps that fair value gap again. This one will be probably pretty damn difficult to catch, but still a retirement setup. Why? Because it closed higher and then pulled back toward the open or toward that low. Turn around and really, really gave a dive there. Now, for those of you who have been around a while, what's this right here? That's a fair value gap that's been there and has been opened. So it's a retail death trap. That's what we call it. We believe that market makers will now target that gap because they tried to get near it. And you can see they gave a stop hunt even. And then they pulled back. Generally, we can measure the previous day's range when that happens, but we won't go through all that. And then you can see right here, runs it. Pretty hefty too. Pretty hefty run. And then business as usual. Let's draw that fair value gap out. You can see, same thing, closes above, runs higher, runs the fair value gap. Now, that's the high of the week. So what are we going to consider this again? Exactly. Retail death trap. So we had one here. And that's how you know, though, this is one thing. This is how you know that what we're seeing is correct, because it goes up and it fills that 4-hour fair value gap, and then it's done. Now, again, you can see this is a pretty massive run, and it's from our trade. We have a retail death trap there, it pulls back, then it runs that high of the week. We turn right back around and we start doing the same thing. Yeah, so you can see we ran it, retail death trap. We really just dumped. We kind of sat here around our 4-hour fair value gap and then got a couple more trades. And to that downside, we really don't have any context there, but let's see. You can see there was a daily fair value gap here. $767. So y'all see that small fair value gap right here on the daily? Remember, that's a daily gap. And then look, right here, we have a daily gap. And look at our silver bullet. It's trades down, gives us confirmation to sell toward the daily gap. Sells off at the open. Then right here, silver bullet, again, closes below the range. This one doesn't really give you an entry, but still played out. And then bam, fills that daily gap, and then they close. They end the range right there in the daily gap. But this will just help you not only get good timing, but it'll help you with your context because you'll be able to know to attack these levels, or at least look out to attack these levels that are very significant. Cool. All right, guys. Any questions? Anything at all? Anything you want to know? Oh, there's a couple. Cool. Yeah, it's a really cool strategy. I've kind of had to game it a little bit to get it to work a little better and make a little more sense. The way ICT had it was he was just telling everyone to trade it with a fair value gap, which is algorithmically sound, and that's fine. But it just it left things to feel very ambiguous for me. And then so the DR IDR concept, that's why I was saying watch the video. He uses 8:30 to 9:30. There's just some there's a lot of stuff with that strategy that makes it difficult, but like I said, it it is helpful, especially with entry patterns. Well, all right, y'all. Can anyone think of any last second questions? Cool. All right, this was recorded. I was thinking about just sending it to everyone that made it on the call, but I think I'll go ahead and post it to the group as well. But since y'all made it here, I'll let you vote. So if you want me to share it with everyone in the group, vote with a Y. If you don't want me to share it with everyone in the group and just keep it exclusive to the 11 that showed up, just put an N for no. So should I share it with the group? Yes or no? Everyone's got to vote. Y or N? One N, two N's, three N's. Okay. 4. 0 and 4. 0 and 5. Okay. 0 and 6. All right. We need one more.
All right, guys, appreciate you watching the video. I hope this strategy helps you. Make sure to click that link down in the description and message me if you have any questions about this. Make sure you like and subscribe for more content like this, and I'll see you in the next video.